Hey everybody, it's Chuck Barone. Monday, November the 20th, 2023, and we're already off and running on another week of crazy. I gotta tell you, man, the whole world's off its rocker, right? So, you read the story this morning. The chairman of ChatGPT, it's OpenAI.com, I believe, kicked out. The board fires the guy. He's a founding partner and the CEO of the company. Microsoft swoops in, offers him a mad, gigantic contract to head their AI research department. And the board, and now the employees at OpenAI, having a big protest, want him hired back, like a big part of the company, threatening to resign and go join him at Microsoft. It's like, what on earth? So Microsoft stock hits an all-time high today. What are these boards, what are these guys thinking? Anyway, I don't know exactly why they kicked him out. I just thought the story was amusing. And just goes to show you, man, cutthroat. They still playing those games out in the world. And maybe the markets are about to get better. That kind of stuff usually inspires, more there's always the signal the market is turning, and it's always something real weird, right? This maybe is the one. Who knows? But anyway, before I get rambling on like I do, let me take a half a second. Welcome everybody to the show. And as always, thank you guys a million Brazilian times for your support. You know, you guys showing up, watching the videos, keeps us going here. We appreciate you guys. All right, so let's talk about the markets today. So we have this Microsoft news. We have pretty good earnings. We have the market half-assed pretty much believing that this rate hike cycle is finished. So the market's responding today, rally city. The Dow up 203 points. Now over 35,151. The NASDAQ up 159 points, 14,284. And the S&P gains 33 points, 4,547 on the S&P. Across the board rally, everything rocking and rolling. Stocks happy. I think if it comes to the Fed making a move to cut rates sooner than the market expects, you could really see the stock market take off nicely. The bond market today kind of mixed, a weird day. Kind of the normal kind of quiet day though. Yields not going crazy like they have been. Was a big day in bonds today. I'll talk about that a little later in the show. But the 10-year today actually falling 2 basis points, sitting at 4.42%. That's a big drop where it was just, less than 2 weeks ago, sitting at around 5%. The 2-year actually up 2 basis points, 4.92%. So now the inversion is widening back out. It was down to about 14 basis points. Now it's about 50 basis points. The markets are not behaving normally. It's kind of, abnormal is the new normal. I don't know. But the bond market's settling down a little bit today. At least there wasn't that gigantic volatility that there could have been, especially with a $16 billion Treasury bond auction going the same day. The dollar today down with doubts now in the markets about interest, about higher rates in the U.S. The dollar's probably going to start coming back down to earth pretty quickly. Down about 1/3 of a point on the index today, sitting at 103.49. Still a strong number. Anything above 100 is a strong dollar. But, at the peak, I think it peaked out at about 114 or 115. It was recently around 106. Now coming back down to earth. I'm surprised that gold and silver are not rallying more. I think you have some people taking profits here, trying to push the price down a little bit. Let's scare the chicken-hearted out of this market, swoop in, buy it at a lower cost right before the big rally, which is coming as this dollar continues to come down. Anyway, metals down today, surprisingly, Gold falls $4.10, $1,977 even for an ounce of gold. Silver falling 32 cents per ounce, sitting at $23.40 for an ounce of silver. Still decent numbers, man. You know, I mean, silver's down about 10% from its peak. I'm guessing gold is about the same thing there. Maybe not even really, because it was at 2,000. So a 10% correction would put it at 1,800. It's well above that. It's more like a 2% correction. Anyway, gold and silver holding their own. And like I said, I believe that as the dollar comes down, especially if it falls under 100 and continues down, you'll see gold and silver really blast off. Oil today rallied up a little bit, up $1.61, sitting at $77.50 per barrel for West Texas Intermediate. I tell you though, guys, these prices I don't believe they're going to hold. Although the almanac was talking about a pretty cold winter, I still believe oil wants to trade between 70 and 75. And until I see firm evidence that that's not true, I'm going to continue to believe that. So I believe oil has a little bit of ways to come down, and it'll get into that trough soon enough. You'll see. Bitcoin today rallies up $514. Bitcoin selling 37,401. Good strong number for Bitcoin. Well above its lows. There's a lot of rumors about Bitcoin, even with the negativity in the cryptos. Bitcoin continues to rally. I'm guessing there's some real money behind this. When you move an item like Bitcoin, which I would say is kind of a speculative item, and you rally it up from 16 to 37, you're going to get some attention, and it certainly has. Okay, so as we do every Monday, let's talk about news we're going to get this week and how it could affect these markets, what we're expecting. Today, we're going to get leading indicators. I'm sure it's out by now. I have not seen it yet. They're expecting leading indicators to be down 0.7%. They were down the exact same 0.7% last month. Leading indicators showing a negative right now, showing possible recession. Even with consumers still spending like crazy, indicators coming down. As we get that number, we'll talk about that a little bit tomorrow on the show. Tomorrow we'll get existing home sales numbers. Those numbers are expected to crater pretty good, not because there's not demand for those houses, because there is, but because there's no supply of existing homes for sale. And you've heard me talk about this on the show a million times too. Everybody locked into their 3% mortgages. But they're not willing to get rid of those 3% mortgages to take on a 7.5%, 8.5%, whatever. The rates are fluctuating like crazy these days, but high, significantly higher than 3%. So they're going to sit in their house they're in with that mortgage they're comfortable with. I don't blame them. So existing home sales expected to be down pretty dramatically. Wednesday this week will be the big day, the big data day at least. We'll get durable goods orders that day, which will give us an idea of durable goods. A lot of that goes to manufacturing. Obviously, the durable goods are produced by manufacturers. That's the number we're looking at. But a lot of businesses have to order durable goods. So the business cycle, you get an idea of where it's at with that report. We'll get Freddie Mac's real estate mortgage report showing rates considerably high and probably likely to stay that way. We'll get some sad numbers on sales. And also on Wednesday, a little day early this week, we'll get jobless claims expected to come in at 229,000 last week, up from 200 or down, or actually going to be down a little bit from 231. They're expecting 229 this week, down from 231 last week. We'll see where that comes in. That'll be interesting getting in on Wednesday. Or no, that's a Thursday thing. But we'll be able to wrap the week up pretty nicely with those numbers. On Thursday, we'll have Thanksgiving Day. The markets will be closed, and hopefully we'll all have a great day of turkey and family and football. And then on Friday, the markets are going to close early, 1 o'clock Eastern time. So, by the time I'm getting to the office here around 9:30 or 10, the markets are going to be wrapping up for the day. We're probably going to take the day off on Friday from the video. do a little Black Friday for the guys here. And unless there's something really dramatic that happens in the market that day, we're probably going to take Friday off. All right, so let's talk about what we need to talk about today. No real data to talk about today, but I did want to talk about this U.S. 20-year Treasury bond auction that came today. You guys might remember, I think it was last week or maybe in the week before, the Treasury was doing about $12 billion or $10 billion of 30-year Treasuries. They were not well received. The yield on 30 years spiked up pretty dramatically from what they thought it was going to be. And that created a little bit of panicky kind of frenzy in the bond market. Well, today we had a $16 billion auction in 20 years, or 20-year T-bills, or I guess it would be notes, bonds. I can't remember exactly when it goes from bond. It goes to bond from bill, right? So it starts with notes, then goes to bills, then goes to bonds. Anyway, thankfully, today's auction had good, strong demand. Yields actually lower than they were anticipating. That was pretty good. But sadly, the yield the Treasury is paying on these significantly higher than what the yield on 20-year Treasuries was getting a year ago. So the interest rates for the government significantly higher. As I mentioned, we had that 30-year auction. Those bond auctions really freak out the bond market if they're poorly received. They typically are not. I mean, Treasury sales are usually pretty simple. They bring, boring. It's pretty boring. They're usually oversubscribed before they even bring it out. These days, it's a little bit different. These are almost like must-see events now. Is the demand going to be there for this level of supply? Treasury pumping $1 trillion worth of treasuries in just the last quarter of this year. They've still got quite a ways to go. So this is some scary stuff, because if these, obviously they'll sell the bonds, but if the demand for those bonds is weak, then the yields spike up, and that, the government can't afford that. I don't see the Fed getting involved. So we'll see if demand can keep pace with the supply that the Treasury is dumping on these markets. It seems like every week we got $10 to $20 billion worth of auctions going off. It's just outrageous. The Fed, no help. They're not buying bonds right now. Actually, what they're doing, they're shedding billions of treasuries every month. As these bonds are, maturing, they're taking the cash. They're not rolling it into new bonds. So that demand is gone. This quantitative easing where the Fed's going to buy bonds. So and then we talked about that last week on the show. The Fed is creating what they are calling a meaningful reduction in M2. More than 2.5% M2 down. Now, I spoke about this last week, how the history of these currency reductions never ends very well. The last one was 1931 to 1933. We'll see where it all goes, guys. My gut tells me this is not going to end well, in spite of what the market's thinking here. So we'll be here to watch. We'll be here to bring it to you guys in living color, man. The crazy goes on and on. Anyway, guys, that's it for the day. We appreciate your support as always. If you can, please hit the like button. It gets our video, it changes the algorithms at YouTube. It gets our video into a few more people's, onto their screen. Maybe we get a shot at some new viewers. As always, hit me up in the comments. I'll be on today, hitting comments up and answering any questions. Have a good evening. Great football game tonight. Chiefs versus Eagles. I'll be chilling watching that. Until tomorrow, guys, take care. Thanks.